Hey guys, so I've had a lot of questions. We were talking about life insurance and everything because that's the financial service industry. That's one of the tools that we can use and leverage. And right now, there's actually a lot of discussion on proper protection, financial literacy. And one of the questions when you talk about financial literacy and education is that you really have to understand how these products work because sometimes people don't really understand how they work. So they don't know how to make it work for them or how it can fit into their portfolio, right? So I spoke to a group of people and we asked about or we talked about life insurance. And a lot of people still believe that life insurance is really designed to die and then the money pays out to the family members or the beneficiaries. And that is probably the most simple, basic form of protection. But that's only like the beginning. Like that doesn't even scratch the surface to really what you can do with life insurance, right? And depending on your needs, depending on where you are, depending on what you're into, if you're a real estate investor, if you're a restaurant owner, if you already have multi-billion-dollar businesses and you're looking for something to cover inheritance tax, there's a place for it all. Okay. And the reason why I say that is because there is no one size fit all kind of design, product, or program, right? Understanding how they work and then using them to the maximum, tax codes and everything like that is where you really find the value in something like a life insurance policy. I mean, first off, there's term and then there's permanent policies, right? Term is temporary policies designed to expire after a certain period of time. If you can get term policy that has living benefits, that's probably going to be the most beneficial because even though it's going to expire in 20 or 30 years, at least you get that additional benefit if something does happen and you need it to replace an income. Then you have the living benefits there. All right. If it's health related issues, if there's any disability issues, you have that option there. And that's really, what life insurance should be looked at is income protection, right? Or income insurance. In the event something happened, you still replace the income that you would have made to take care of your family, take care of debts or obligations, cover assets, whatever that may be. So that way it doesn't disrupt the ecosystem that you've built. Okay. So, for example, I get a 30-year term, and along the way, something happens either a car accident, a stroke, something that leaves me disabled, right? Now I lose the opportunity to go to work and get paid. But if I have living benefits, then it starts paying out. If I qualify and everything checks out, I start receiving the life insurance in in portions, so that way it can cover X amount of years to replace that income. At least it will give me that much more peace of mind where I don't have to worry about the loss in income and still be able to have that quality of life as best as possible for a situation like that. Another good example for 30-year term, for example, might be a 30-year mortgage. Someone buys a house, takes maybe two income, husband, wife, or someone individually who buys a house, or real estate investors who buy rental properties, right? A 30-year mortgage, 30-year term. And in the event anything happens within the 30 years that mortgage is still active and you no longer can pay the mortgage or even pass away, the life insurance would pay out, and then you would just use that benefit to pay off the mortgage. So that way, your family wouldn't have to worry about that stress. They wouldn't have to, worry about the tenants. They wouldn't have to worry about the maintenance. They already have a lot going on emotionally, right? Financially, it shouldn't be a burden. So those are some good examples, two good examples that I would look at a term policy. Now, when it comes to like permanent policies, you have options. You have whole life, right? Fixed everything, everything's guaranteed, fixed, right? And then you have universal life, and then you have variable life. Variable life, it goes into the market. Market goes up, your interest earned goes up. If the market goes down, your money also goes down, right? So we're not going to talk too much about the market because if you're going to play in that realm, then you know what I mean. Then stock, like you would, it might be beneficial just to get mutual funds and get a term or something like that, right? Depending, every situation is unique, but variable, depending on where you are, like if it's an abundance of money and you just don't know what to do with it, then that might be a good portion too. Mainly because with life insurance, you're trading off a small amount of money for a large protection plan, right? You might pay $200-300 a month, but you might have hundreds of thousands or millions of dollars in coverage. So if anything happens, the millions pay out or hundreds of thousands pay out. And chances are you probably didn't pay that much into that policy, right? Depending on how long you live and all that, the way it's designed. But we'll look a little bit in with whole life, you know what I mean? Fixed interest rate, like for the people that are really worried about the market, and if it's going to be like a depression season where you're talking about 10 years of like lost earnings, then a whole life might benefit there. But if you look at the S&P over the last 20, 30 years, they say it's always going to come back up. It's going to rebound. Like it's always going to trend in a positive direction. It might take long, but it might, you know what I mean? But it will trend up. That 4% fix isn't really that attractive at that point, right? So it really depends. And then yes, you can buy paid up editions, and you can, do other things with that. But for that, why not just go with an index universal life, right? Index universal life isn't for everyone. Like there's also other criteria and factors to look at. But if you're looking to overfund something or let something grow until you pass away, then it might fit your portfolio. But we're going to look at some ways that people have used it, just because sometimes people think life insurance is you die and it pays out. And we're here to say that's not necessarily true. So whoever told you that isn't being completely honest, right? I have ChatGPT, I have Google. And I'm just going to use this one real quick. Who have who has been able to leverage cash value life insurance to expand or build their assets, organizations, or businesses in the past, right? And I just want to see what's out there because this is Google. We can do ChatGPT also. And you'll be quite surprised because a lot of times, a lot of the franchises that we see out there that are well established have been built on life insurance, right? And then here we are, like the common everyday person in inner cities who think life insurance is a waste of money or has really no value, and that's really the problem, right? So here, if we look and just read, we won't even read it all, but we'll just briefly go. But look, we got Walt Disney, right? Walt Disney, banks didn't loan him the money that he needed to open Disney World or Disneyland, one of those, Disneyland right there. So he borrowed money from his cash value life insurance to start it up. And look at where Disneyland is today, or Walt Disney's legacy is today. And that's the important word here is legacy. So what do you want to leave behind? You want to leave 50,000, 100,000 just to pay off debt to your family, or do you want to leave a legacy, right? Something that never runs out, like the Rockefellers, Ray Kroc McDonald's. They used it, right? Nowadays, they just rent out the franchise name McDonald's, but they really make money from the real estate that all the McDonald's is built upon, right? But they were able to use policy loans from two of his cash value life insurance policies. So, when you talk about, understanding how to leverage these tools, it's important because J.C. Penney, Pampered Chef, Foster Farms became, oh, they raised chickens and they produce eggs. Stanford University, I mean, these are all people that are known through history to leverage life insurance in order to expand their business, right? And if we dig into this a little bit deeper, if we dig this into a little bit, how did the Rockefellers use cash value life insurance to build their family trust, which is known as dynasty trust or legacy trust, depending on who you talk to. Um, because if you understand how this works, you can create this for your family. That's the point, right? So the Rockefeller family used cash value life insurance, particularly the waterfall method, to build and perpetuate their family trust. Let's see, did they go into detail? Because what they did was they bought a life insurance policy. They did not name the beneficiary any family member. What they did was they put it to the trust as the beneficiary, and then they gave directives to the trust to buy more permanent policies on every single family member. All right. So it never runs out because the beneficiary to all of those policies is also the trust. So it continues to cycle through. And the reason why they do that is because life insurance is tax advantaged, meaning that if you use it right, it could be tax free, essentially, if you use it right. There are some occasions where you would have to pay tax, and that's usually if you're going to cancel it. If you're not using it properly, taking out too much, then you should, But you get tax advantages where it could be potentially tax free, right? Wealth preservation, because again, life insurance, the trade off is you're going to pay a little bit into it to get a lot more out of it, right? So you got that wealth preservation, it builds into the trust. So, like, it's going to take care of everything, like I mentioned. It's never going to run out for the Rockefellers. And then you can transfer that down to your family, not directly to them, but through the trust, you can have them access the money they need for whatever they need, however they need it, whenever they need it, without any penalties, fees, taxes, right? Restrictions, unless you restrict them specifically based on how you design it. Um, Dynasty trust, legacy, family values, you know what I mean? So, like, those are ways where you can really benefit from that. Okay. I mean, and then the last person is a more recent one. How did Jim Harbaugh, who is, let's say who is, because some people may not know who he is. Who is Jim Harbaugh? And how did he use the Index Universal Life with Michigan State, Michigan University? Um, who is Jim Harbaugh and how did he use the Index Universal Life with Michigan University for his coaching salary? And what benefits did it provide? And this is not that long ago. It might be like less than 5 years. Let me see. Jim Harbaugh, former NFL quarterback, uh, Chargers. He did a split dollar life insurance policy with an IUL with his compensation arrangement. And what they did was Michigan gave him a $14 million loan, right? A loan. So they let him borrow $14 million. And what he did with that $14 million was that he used that to pay into the IUL, right? Where you made 7 loan advances, $2 million each, to total $14 million, and he used that to cover a 7 pay for an IUL policy. It ended up buying him, I think, 48 or $53 million, something in that range of coverage. So if anything happened to him, he has access to 48 or $53 million. Like, it was 40 million plus. If he was disabled, he has long-term care, living benefits that would come from the 40 million. If he passed away, his family would inherit or receive the 40 plus million. I'm sure it probably went to a trust too. But in that policy, if you're putting in $2 million a year, he's going to have instant cash value, probably in the millions too, like a million or like hundreds of thousands, if not a million, right? So he has access to that if he really needed it. But if you allow it to grow and compound in the policy, it continues to multiply and expand exponentially fast, right? So he has that ability for tax-free cash or borrow from it. Tax deferred growth, everything's going to grow in their tax deferred, and if you use it right, it'll be tax free. And then what ends up happening, he's just going to pay Michigan back the money at some point with all the earned interest that he has, or if he passes away, it will just pay out from the 40 plus $1 million. They'll get 14 million plus whatever interest agreement that they agreed upon for that. So what are the benefits? Tax free income. You know what I mean? If he let that ride, he can probably pull out millions every year in retirement until he died, and it would still never run out because of how it's going to compound over time, right? Tax deferred growth, again, we spoke about it. Access to loans, you're borrowing your own money versus borrowing money from the bank. You can buy buildings, you can buy real estate, you can buy islands, you can buy anything you want, really, right? And then the way it works is that if you don't pay it back, let's say you borrow money from your cash value and you don't pay it back, they'll simply deduct it with any interest owed on the back end of it. Okay. Obviously, he's going to have an estate. Life insurance by definition will create an instant estate for a family. So when you're talking about generational wealth, and this is a permanent policy, your family is going to have an instant estate. Versus if you buy a term policy and you outlive the term policy, you no longer have that instant estate, right? And then the incentive to stay, the IUL policy combined with the split dollar loan agreement served as an incentive for Harbaugh to remain. Of course, he went to the Chargers after that. Um, but look at the creative ways that they were able to use life insurance to secure the talent, the experience, the skill that Jim Harbaugh has in football, uh, and retain the talent, right? What, life insurance has been around for a long time. What is BOLI and how was it applied? And I say that because we go to banks to borrow money, but what we don't know is banks buy life insurance on their top execs and they never run out of money and they use it. What is BOLI and how was it applied? Um, because then, I mean, some of their retirement pension packages, whatever it is, they would use the life insurance that they opened on their top people, tax free, cash value available whenever, to pay out whatever they need. And then when the time came, when that person passed away eventually, because everyone does, the life insurance policy pays out to the beneficiary, which in this case would be the bank, right? So BOLI is a bank owned life insurance, purchased and owned by the bank with the bank as the beneficiary. They take care of everything. They use the BOLI to offset costs associated with benefits, retirement, healthcare, other compensation plans, and then the death benefit is paid back to the bank. Okay, so it's not like the bank sells you a checking account or a credit card or a mortgage, but it's not like the bank buy the mortgage from themselves. What they do, they buy life insurance on other people, and they're leveraging other people's time and money to build their foundation. Right. So how is it applied? They fund employee benefits with it. They have tax efficient investments. They have key person insurance and asset liability management. Right. So even if, like, for some of you that have business partners in restaurants or salons, barbershops, Uber or transportation businesses, if you have business partners, if something happens to your business partner, you're left holding the bag on their debt or whatever they owe, right? So if you went 50-50 on a business and they're no longer around, now you're doing twice the amount of work because you're doing their job as well. Plus, whatever investment they put in or continue to put in is now no longer there. So now you're literally stuck holding the bag, right? So with this, I'm just going to use ChatGPT. I mean, Google there. ChatGPT is going to give you pretty much more explanation. But a lot of people talk about, buy term and investor difference. You got the Ramses, you got the Susie Ormans, you got the Primerica agents and stuff. And, there's nothing wrong with their strategy. If people are limited with funds or they just don't understand how things work, it's better to have a term than not have anything at all. I'll say that, right? But now that we explained a little bit on permanent policies, let's compare it just to see, what this says. Um, for an average person who makes 100K a year, and let's say just 100K. Nowadays, I think that's kind of like where pays are. For an average person who makes 100K a year, looking to build a stream of income in retirement, and this is like, really guiding the question, because I'm gonna put what I want in a life insurance or what I want in a retirement. Okay, because the one thing I do know is taxes will always go up, so I'm gonna want something, looking to build a stream of income in retirement with little to no tax liabilities. um, Growth potential, of course. I want it to grow. I don't want something that's not going to grow. um, let's say protection in case of disability or death. Right? Again, I'm guiding this, and without having to worry about expirations on coverage. What would be the best option between buy term investor difference and an IUL? Let's take this a little bit deeper too. Let's. Oh, I didn't mean to hit enter. I meant to go screen down. Because I was going to say, let's assume, we'll ask that a little bit after I read this. For an average person earning 100,000 a year who is focused on building tax advantage retirement income, having growth potential, protection from disability and death, because again, term can offer that if you have living benefits. Okay, so growth potential would be the invested difference, mutual funds and like stocks and stuff. Okay, tax advantage retirement income. The only thing you're going to get tax advantage from by term invested difference would be the term. And ensuring lifelong coverage, okay. I mean, lifelong coverage, the only thing that's going to give that is your IUL. Minimizing tax liabilities, that's also going to be the IUL. So, I mean, for me, like I said, I'm going to cater it. But if I asked any person, what do they want out of their plan? Chances are they're going to tell me this is what I want. Like, I don't want to pay taxes. I don't know if it's going to go up or down in the future in 20, 30, 50 years when I go retire, right? I don't want to have to worry about other people around the world making decisions that's going to affect my market, that's going to affect my growth, right? So the better choice long term is typically a properly designed IUL rather than by term and invested difference. And that's a no brainer, right? Because I mean, I can ask this a little further and say, why do Primerica agents always push that? You know what I mean? They should put more money into the market. I mean, I will ask that, but let's look tax free retirement, IUL, growth potential, IUL. Well, both, okay? Disability death protection term only if it has living benefits, okay, and within the range, because Primerica term does not have living benefits on them. All right, for as expensive as they charge for a term in the market, they don't have living benefits. Coverage expiration, unless they just recently added it. Coverage expiration, term expires, okay. IULs don't. Tax liabilities, all your investments, capital gains, taxes, management fees, that's where they really make their money, financial advisors, is through the fees. They say it's a 1% fee, but it can take 20 to 30% of all your earnings. IUL grows tax deferred and distributes tax free. Access to funds, they're both liquidable. Risk of loss, definitely in the market. You know, anything in the market is going to be exposed to volatility. And legacy and estate planning, no automatic legacy if not alive at time of payout. So if you outlive the term, you get like nothing. You know what I mean? Just whatever your investment portfolio grew to be. So why IUL may be a better fit? You know what I mean? Lifelong protection, tax-free access, living benefits, protected growth, estate planning. If you want to screenshot that, that's fine, or press pause on the video, that's fine. BTID only works perfectly if you actually invest the difference, okay? And not only the difference, but you gotta maximize when the market does crash, okay? So if the market crashes, right? Let's move this back over, and let's look up S&P 500 last 30 years, okay? The reason why this is important is because for that to work efficiently, for it to work, by term invested difference, for that to work efficiently during these years, if you look in 1999, I wonder if I pull up my pen if I can write on it. No, it doesn't. I got to figure out how to use all this stuff. In 1999, they had the whole dot-com scare and everything. Everybody was afraid Y2K, the world was going to end. From there on, we had 2001. We had the 2000, the scare, and then we had the 2001 9/11, which brought it down. Okay, and then we had the 2008 crash. If you follow me on these little pointers on the screen, the 2008 crash happened also, right? It took the country 13 years from 1999, if you can see where I'm pointing at, to 2013 to break even. Okay, and the problem with this is if you had $1,000 in 1999, and then it took you to 2013 before you got that $1,000 back. Let me ask you, how much purchasing power does your $1,000 have 13 years later, right? Because that's a really important question to know. They're always going to tell you, oh, the market's going up, it's rebounding, it's recovering, blah, 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 blah. But it took 13 years to break even. And then the problem with that is that the 13 years it took to break even, by the time you got your $1,000 back, you probably had $700 worth of purchasing power. And what I mean by purchasing power, for those that might not get it, is that back in 2000, when I was starting to drive, gas was only 95 cents. So my dollar back then was able to at least buy 1 gallon of gas, right? You fast forward to 2013, my dollar couldn't even buy half a tank of gas anymore. That's what purchasing power means. And the reason why this is important is because if you retired, let's say at 65, and you live for 20 years, how much gas is that dollar going to buy you 20 years later? How much bread, how much water, how much food is that same dollar going to buy you 13 years later? So you can't, you know what I mean? Yes, the market, if you could leave it there forever, the market will always go up. But if you ever get caught in one of these downward spinouts, it takes a while to recover that, right? I mean, the simple math logic would be if you had $100 today, you put it into the market, tomorrow it lost 50%, you're left with $50. Let's say the next day the market goes back up 50%. How much do you have? Right? Just think about it real quick. You have $100, the market went down 50%, you're left with $50, and then the market goes up 50%. How much do you have? Some people would say $100 again. But the truth is, you only have $75 because 50% of $50 is only $25, right? So in these dips, what I meant to show you was in these dips where the market did crash, chances are if the market crashed, you probably don't have extra money sitting around in your pocket that you're gonna take advantage of the opportunity. Because when the market crashes like that, that's when you pull out big chunks of money to buy even more stocks. Because what you're waiting on is that you're gonna buy something at a low price, right? 10,000 shares, 1,000 shares, $10,000, 100,000, or whatever it is. That's when you dump in money like that to buy these lower priced stocks, so that when they go up, you can dollar cost average price per share to gain more money because of the higher quantities, right? But chances are, in a market crash like this, people were probably scared. They weren't going to pull out even more money to buy more money into the market, right? That's the buy the difference part. How many people are really going to buy that difference? Like if you stay consistent and steady, that's great, you know what I mean? But like you got to take care, or you got to take advantage of those opportunities, where that's really going up, right? So I mean, even this alone, like explaining it, for those that are in real estate or looking to buy businesses, I'll expand this. For those who are interested in real estate investment, what 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 order would make sense to create a secure long-term strategy that will guarantee is a tough word. I'll say that is, but a strategy that will guarantee generational wealth and prosperity when it comes to, or in regards to, buying and funding an IUL, buying real estate to invest and hold for rental income, um, to have the to have proper planning, proper, let's say estate planning, just to make it more clear, in place, and or other investment opportunities for asset accumulation, right? What order? Because it's important. Because some people will say, I'm going to buy real estate first, and then I'll figure it out later, right? So let's see what this says. To create a secure long-term strategy that builds generational wealth and protects your legacy, you need a coordinated wealth building plan that blends insurance, real estate planning, and asset accumulation in a thoughtful, tax advantage, and sustainable order. All right, there's an order to these things, because if you start in the wrong order and something happens, everything falls apart. Okay, so financial education, we offer free workshops. Okay, for those that are new and hearing about it all for the first time, we offer free financial workshops either in person or on Zoom. However, but we believe in educating the community, because if the community doesn't know what's out there, they don't know where to really place their options. Right? Cash flow management and emergency funds, always have that in place. Again, you don't want to get caught holding the bag. But the third one is properly designed IUL. And this is something that, a licensed financial professional who understands how it works versus just selling you something to sell it to you. They understand, depending on how you want it, minimum death benefit, maximum payout, non-MEC, right? Non-MEC meaning you don't want to put too much where it converts into investment account, or like a 5-pay, a 7-pay kind of system. All right. Some people do term riders on top just to show that the policy coverage is higher just so they can have a higher maximum for the year. But these are all things that, if you're sitting down with an insurance agent who knows what they're doing, they should be able to break it down, explain it to you, and show you the illustrations. But the first thing is, other than financial education and then the cash flow or emergency fund, is to have a properly designed IUL. And for me, I'm biased. So obviously, I'm always going to defend this approach. But I talk to people and they're like, oh, I'm going to buy investment stocks first, and then I'm going to take the earnings from that and then fund an IUL. Or I'm going to go buy a real estate property and then I'm going to take one unit of rent and use that to pay for my IUL. And that's great until you have a major repair or maintenance on the house and you no longer have income from the unit, or you don't even have tenants in there in the first place, or you got to evict the tenant, right? And then all of a sudden now you don't have the funds that you were looking for to pay into it. Or what if your stock and investments and all that didn't create a great return? Plus, you got to pay capital gains tax on that, right? So if you got short-term capital gain, let's say you put in an investment and you made $1,000 in a day or two, right? Day trading, you got to pay capital gains on that. So you really don't have $1,000 to put into something like an IUL, because after capital gains tax, you're left with maybe $500-$600. Is that still good? Yes, but if your investment fails or if something happens to you, let's say you're disabled or you pass away, well, I mean, your investments, your stocks, mutual funds, they're not going to pay out millions of dollars. They're just going to pay whatever you have in the market minus uh, capital gains tax, right? Phase two would be the acquisition of real estate. Okay. And then you would buy and do whatever you want, buy and hold, rent it out, flip it, whatever you want, right? Um, phase three, I think phase three should have been earlier on, maybe in the first phase where you're creating your estate plan. So that way everything is owned inside your trust. But this is putting the trust in third place. And then four, continue to diversify and grow, right? And again, look, you can use IUL as a private bank. You can expand your investments. You can pay benefits. If you have business partners, you can buy key employee insurance on them. If you're paying taxes back to the government and the IRS, you can executive bonus yourself and then use the bonus money to pay into a IUL, right? But these would be the steps. So I'm not here to dispute it, right? BTID and investor difference, yes, it can work for some people. Knowing what I know, will I take that strategy? Probably not. My investments are in my like HSA because the money's already in there. If it grows, it grows. If it doesn't, I mean, that's just my health insurance or health coverage related money that I'm leaving there. Because if I use it for anything else outside of health, you know what I mean, I'll have to pay taxes and potentially fees on that. Um, do I have some investments outside? No, just my 401k. Well, because I get the company match, so I put money in the 401k, not more than the match, just enough for the match, and then my HSA. Because even let's put it in here. Um, how would it play out? Let me see. If I work at a company that offers a 401k and matches up to 3%, let's say 5%. I don't know anybody. Some companies have really good, generous companies. Let's say I have a company that offers 401k matches up to 5%. Um, Someone at 30 years old working for another 35 years, meeting the match, would they have more than the same amount of money? Okay, the same dollar amount, same dollar amount of money without the match. Would they have more than the same dollar amount of money without the match who is putting into max funded IUL design for that amount of money for the same amount of time? All right. What I do want them to keep in mind is include management fees, taxes, inflation, and any other costs that are involved with 401k and or and IUL. Who will have more at 65? Let's see what it says. I mean, I have no idea. Let's see. Great question. Let's compare head to head. 35 years of contribution. Assume $100,000 a year for easy math. 401k contribution. They're putting away $10,000 a year, which is actually pretty good. IUL contribution, $10,000 a year. Self-funded, no match. Will factor in taxes, all that stuff that we mentioned. Quick overview. Contribution, same, taxes deferred until withdrawal. Okay, so 401k, you will get taxed at withdrawal. Funded with after tax-free withdrawals and loans or through loans. Investment growth, let's assume that. Oh, I didn't put the caps. I should have put the caps because the caps does play a role. Fees 1 to 2%, less than 1% in a life insurance policy. Believe it or not, the longer you have the IUL, the less the cost of insurance should be, and the less your fees should actually be. Inflation impact, protection, market risk. Okay. Market risk, fully exposed in the 401k. IUL, no downside risk, 0% floor. We have a company that will give us 0.75, even in a negative market. So let's assume, they're reading everything, 401k with the match, pretty much everything, just really broken down again. Who comes out ahead? Total contributions, 350 includes the free 175. Okay, so total contribution, the 401k and the IUL, same contribution. Spendable value, okay, at 65. In the 401k, you'll have about 855 after taxes. In the IUL, you'll have 1.1 to 1.2 in tax-free loans. Okay, that might be more if we added a ceiling of 14%, versus they only averaged to like a 10% or 6% or something like that. Access flexibility. There's a penalty if you use your 401k or any retirement, IRA, Roth, any of those annuities before 59 and a half, there will be a penalty. IUL, you can use it anytime. As long as you have money in there, you can use it. Death protection, none. Living benefits, none. That comes with the 401k. IUL has both. Okay. The risk, the market. In a 401k, the risk is going to be the market. If it crashes, you're going to see what we see on this side, right? It's going to dip. In an IUL, it's indexing strategy, meaning that if the market's negative, you just stay level or flat across. Inflation protection, limited. But with the IUL is stronger because of the growth that you're able to keep and no risk in the market loss. So even without the match, a well-designed max-funded IUL can outperform a traditional 401k. And imagine that, like they knew this information and they still push a 401k on companies. They took away the pension plans where the company would take care of you after you left the company, and they pushed the 401k because they know that they're going to need that tax money. They're going to let you work hard, save all your money, and then take a chunk of it at the end. You know what I mean? So again, that's no different than a mutual fund, right? In the whole buy term and investor difference, because whoever's managing your mutual fund or investment portfolio, they're taking a 1% fee, which can eat up 20-30% of all the earnings that you have. And if you're not investing more during the crashes, during the negative markets, if you're not dumping in a sizable amount of money to buy low, you're not gonna see any amazing growth when the market is high either, right? But again, life insurance is. Let me ask why. Why is it that people have that understanding? Why is it that most communities think that life insurance is only good for death and funeral expense? And what communities are affected most by the lack of understanding on how different life insurances truly work? Is there a certain demographic? This is actually interesting. I haven't asked this question. Certain demographic or group, demographic or group that pushes term insurance more than permanent insurance. Why most communities think life insurance is only for death, generational misinformation, because if your parents didn't understand it, then there's no way to pass it down. Again, parents and grandparents only experience final expense or funeral expense, which is usually less than 50K. The lack of financial literacy, that's why it's so important for what we do. We offer financial workshops and education because we don't want people to just buy to buy. We need them to understand what they're getting. Sales culture, many in this, I mean, just think of term, right? Many agents are taught to sell the cheapest product, right? Not the most valuable product, just the cheapest product to get clients in the door, because what, again, their real product is invest the difference. The focus is on the death protection, not the wealth protection or asset growth. Look at that. They focus a lot more on the death protection rather than the wealth protection. That's actually pretty good. And price perception. You're selling on cost, not on value. Who's affected most? Black. Oh, look at that. Black, Latino, and low to middle income communities are affected most by this lack of understanding. These groups are often targeted with barrel of final expense. Oh man, I know people that are in Globe Life or something, Senior Life, and all they do is push this. Historically, have had less access to licensed financial professionals. This is why we need more in our communities. Every family should have a licensed professional in their family who understands this, not a Primerica agent in their family. That's hazardous. Systemic inequality and mistrust of financial institutions. I mean, that comes with everything. Immigrant communities, young adults, and working class families. Who pushes term more than permanent? Dave Ramsey, primarily. Look, I mean, I didn't even put it in there, but Dave Ramsey, you know what I mean? I don't know. I don't know. For all you Dave Ramsey people, God bless you. He promotes term only, claiming permanent life is a ripoff. His view doesn't account for how wealthy families use life insurance. Okay, I don't know. Primerica, again, anything I say is based on my own opinion. It's not a representation of anyone, any organization, company, or firm that I work with. It's just my personal opinion because, like, the danger in a Dave Ramsey or Primerica approach is that you're literally handicapping your community from excelling. Imagine an 18-year-old where Dave Ramsey says credit cards are bad and they live their whole life buying everything in cash. And then at 35, they want to get married and buy a home for their kids. And they can't because they've never built credit. You know what I mean? So, I mean, like something like that is counterproductive. But if you understood how credit cards work, they're not bad either. You just got to know how to manage it properly. Because real estate investors will tell you they'll get a 0% credit card, borrow $100,000 as a cash advance, put it as a down payment, 18 months, 0%. They're not paying just the transfer fee that they have to pay, which is like 3%. And then they'll flip the houses like 3 times before they have to pay that back because 18 months, you should be flipping a house every 6 months. You know what I mean? By the time the 18 months is over, you should be able to flip at least 3 houses and profit whatever you need to and then pay back that amount that you originally pulled out. And that's what it means to use other people's money to build your assets, right? Primerica, the company's entire business model is built around term insurance only. They don't offer anything else. They outsource any other products that they might potentially want to offer. While affordable, they often lack the education about what permanency, but they don't even lack the education. They go out there and slander and negatively impact, you know what I mean, people's thinking when it comes to permanent policies. Some fee only investment advisors. All right, for financial advice, for advisor fees, how much can 1% advisor fee impact your overall portfolio of $1 million? So when you have these advisors that say we only charge a 1% fee, like these Primerica agents or New York, whoever, just whoever you have, right? Just understand they really make their money. They're not going to offer you something where they only get paid one time. They're going to offer you something where they can get paid over and over and over again based on your money. Okay. Scenario starting with $1 million, annual return on average 7%. The fee 1%, investment 20 years. All right. In 20 years, that $1 million, let me see. Portfolio growth was with versus without. No fee. If you had no fee in 20 years, you'll have about $3.8 million. If you add in the 1% fee, you lose out 600,000. Some people are like, oh, well, I mean, that's 600,000. I still have $3.2 million. Yeah, but what, like, how would it feel if you had 3.8 instead of 3.2? Like, you know what I mean? That's not the point. The point is you're paying them to win or lose. If the market crashes, they still get paid on your money, But if I could keep that 1% fee, then I would rather keep that 1% fee. And mind you, this isn't even including taxes. This is just the fees. Okay, this is just what you're paying them. So that's $600,000 less. Nearly two-thirds of your original portfolio is gone. Okay, just because of a 1% fee. So if you have someone that's charging you a 2% fee, forget about it. Because the money, it adds up over time. It might sound like a little amount, but it adds up over time. But anyways, I just wanted to do this because some people asked, you know what I mean? Figured it'd be easier just to answer it like this. Hopefully it was a lot of useful information, but if any other questions, just reach out. The easiest way is just reach out and we can discuss it.